Okay, in this assignment, we are going to be looking at the profile of a person, in this instance, Terry Teacher, and what he has going on with his finances. And then we're going to use that information to fill out this balance sheet here. So we'll go ahead and start reading through the profile, and as we hit important pieces of information, we'll pull them out and put them on our balance sheet. So Terry Teacher has worked in education for 25 years and hopes to retire with 30 years of service. His advanced degrees and his current salary is $60,000 a year. Okay, we're going to hold on to that amount and come back to it later. He has a $15,000 in a government-insured savings account for emergencies. So we can go over here and look at savings account, and we're going to do 15,000. The government insured part is typically implied. That's what the acronym FDIC stands for. You'll probably hear that on commercials for banks. FDIC insured is Federal Deposit Insurance Credit. So it is a insurance policy set up by the federal government in conjunction with banks for anybody who is keeping $150,000 or less in an account. And it basically ensures that you will get all of that money back if you would like it. There isn't going to be a situation where the bank can't pay you. Okay, moving on. He tries to keep at least 3 months of his salary available in a liquid account, even though he has sick leave accumulated and a disability policy. Okay, so we're not concerned about the fact that it's an account because these are all technically accounts as they are listed as separate line items. So that means we would call them separate accounts, but that doesn't necessarily mean it's sitting in a bank account somewhere. So the thing we care about is this 3 month salary. So we're going to come back to our salary amount. That's $60,000 a year. And we have to figure out how much he makes per month. All we have to do is divide 60 by 12, and that gives us $5,000 per month. So if he has 3 months of sick leave accumulated, then he's going to have $15,000 in cash. Or excuse me, 3 months of salary in a liquid account. So liquid typically refers to cash, something that you can, cash is the most liquid. That doesn't mean that other types of accounts don't have their liquidity as well. And if we're being honest, technically this is not necessarily in the correct order of liquidity, but you will almost always see cash listed first on a balance sheet because it is the most liquid item. So, and then a checking account is a fund that is going to be sitting with a bank, so it's a little bit less liquid than cash. Okay. He keeps a balance of $1,000 in his checking account after paying bills in order to receive free checking from his bank. Okay, I don't care about after paying bills, and I don't care about receiving free checking. So all I care about is that he keeps $1,000 in his checking account. His teacher retirement account is worth $150,000. And when he retires in 5 years, he can withdraw the lump sum or receive 60% of his highest salary for the rest of his life. Okay, I don't really care about that. That last part. All I care about is this retirement account being worth $150,000. So we're going to go over here to the line item retirement account, and it'll be $150,000. Okay. He has term life insurance instead of whole life. Term insurance is cheaper, but it does not carry a cash value. So that's what we're concerned about, is that it does not carry a cash value. So this line item cash value of life insurance is just going to be 0. Okay. He invested $60,000 in his IRA. IRA is an individual retirement account. So it is a retirement account that you set up outside of your employer. So what we'll do is we're going to do plus 60,000. Okay, moving on. His house is worth $200,000 and the remaining mortgage balance is $120,000. So we have now seen our first liability. So we're going to go over here to real estate, and we're going to put that $200,000 on because that's how much his home is worth. And then we're going to go over here to mortgage balance under liabilities, and we're going to put $120,000. Okay. He owns a condominium worth $50,000 and it is rented out. Okay, I don't care that it's rented out, but I do care that he has a condo that is worth $50,000 and he doesn't have a mortgage on it. Plus 50,000. Okay. He owns jewelry, televisions, and computers worth $3,000. So we're going to go over here to personal property, and that's going to be $3,000. He owes $5,000 on a credit card and has a new auto loan with a balance of $17,000. Okay, so he's going to have a credit card liability of $5,000 and a car loan of $17,000. Terry Teacher has no other loans or debts, even though he has not earned a huge salary. He's lived comfortably, traveled, helped with his children's education, and planned for retirement. Okay, I don't care about that last part, but I do care that he doesn't have any other loans. So this is going to be 0, and this is going to be 0 because he doesn't have any bank loans and he doesn't have any other liabilities. Oh, actually, we're going to move this 200,000. I didn't see that they had home, and we're going to put it down here in home. Typically, all of your real estate, whether it be your home or anything else, would simply be included in real estate. And then it doesn't list any other investments that I've seen. So we can go ahead and put 0 here. Same thing with personal loans. He doesn't have any personal loans. And technically, a lot of these are, again, redundant. A difference between a bank loan and a personal loan. I mean, if he doesn't have a business, then there's not really a difference between a bank loan and a personal loan. So just wanting to point out that this isn't entirely standard, but that's all right. Okay, so now our job is going to be to add up the total value of his assets. So let's see. I'm just going to do it in my head. It'll be 200 plus 150, that's 350, plus 60 is 410, plus 30, 440, 441, 471, no, excuse me, 491, 494, I believe, and I will confirm that number after I'm done with this video. But 494 is his total and current assets. And then we're going to go over here to our current liabilities, or our total liabilities, and we've got 120 plus 5 plus 17. So that's going to be 125 plus 17 is going to be 142. So he has total liabilities totaling of 142,000. Now, to subtract or to determine net worth, all you do is subtract total liabilities from total assets. Net simply is when you combine the expenses and the revenues to come up with basically what number did you come out with, you know, before you start throwing in taxes and all kinds of other complicated calculations. So you'll hear companies talk a lot about net income, and that is basically just their total revenues minus their total expenses. And so we can say net income. All right, so net worth here is going to be 494,000 minus 142,000, and that is going to equal 352,000. So he has a total net worth of $352,000. That means when we combine his assets and his liabilities, he still comes out on the plus side of to the tune of $352,000. So that is all that assignment is. The hardest part was really picking through that that paragraph there at the bottom. It's a bit wordy and a bit unnecessary. So I will go ahead and turn this in.